Good afternoon. Welcome to Chicago Future of Finance. I'm Oliver Renick. We have equities under some pressure again with the S&P 500 down now at the lows of the day, lower by 1%. S&P trading 66.46 right now. So obviously we've been getting hit. Volatility was looking for a bigger move earlier. We had VIX 25 early in the day, and it looks like we might be moving towards the volatility instead of away from it. But market's still within generally the range that we've become fairly accustomed to, which has been a pretty wide 300 to 400 point range, basically, for the S&P with a high of about 7,000. And then to the downside, roughly this 6,600 area, which seems like it's going to be some support. Having a little bit of tech issue with the internet down here, but here's the risk radar. Before I changed it to the all yellow, now it's right there with stocks, range bound, Bitcoin, bonds, dollar, gold, just a lot of charts going in circles kind of sideways without a lot of real direction. But this certainly has been generally the options traders kind of paradise with volatility elevated and the overall market going sideways. We've also got the Fed doing basically nothing, sitting on its hands, waiting for something to give them, I guess, a clearer sign. Obviously, interest rates kept on hold. That was generally the expectation. No surprise there, I think, really anywhere. Looking at the headlines, obviously, that is the expected move. Powell obviously watching crude oil like everybody else, trying to figure out what to do about that. But generally right now, it's just a game of speculation, really trying to figure out the knock-on from crude into inflation and then into interest rate path. That is a very tough game to play. So no surprise for Powell doing nothing until the S&P 500 cracks through 6,600 to the downside. Then just hard really to describe this market as anything other than range bound. Dollar is catching a bid today. 10-year yield is also up. The 10-year at 4.3% is definitely making some headway, but still not a huge amount of headway necessarily. Got a good show coming up. Brent Kochuba is going to join us while he's on the road, talking about volatility and the general landscape as we go into options expiry, of course, which is going to be a pretty big deal as well. Scott Nations joining from Nations Indexes, take a look at the way he views things, in particular looking at out-of-the-money options, seeing how the pricing is changing on the tails for the market right now. The groups that were showing some life, like Bitcoin, not doing great, down today, getting hit pretty hard. The gold trade that had been flailing is still doing exactly that. So there is certainly generally a risk-off tone across a lot of different assets right now that is certainly frustrating, but still I think the story has been the range, and the market's still holding into that range. Got Mr. Brent Kochuba joining me on the line. Hey, Brent, you hear me?
I can, Oliver. How you doing?
Hey, excellent. There we go. Navigating technical stuff. Market kind of navigating a very sideways move. Looking at your website, I just pulled up SpotGamma right now. There is obviously some pressure coming in over the last hour. Tell me the levels that you're watching here for the market and what's holding versus what might be breaking.
There's two interesting things. We've had a lot of negative gamma, which should be a lot of volatility through various ranges, right? All the way from roughly 6,500 all the way up through 68, 6,900. And what we saw yesterday was a lot of call selling. Traders coming in and selling calls in the 6,800 range, which implied resistance. And what was interesting to me about that was we were coming into VIX expiration, which was this morning. So yesterday was the last day that VIX contracts could trade for March expiration. And we had a very fat vol premium heading into this, right? 10 to 12 points, which is like a top 20 in the last 10 or 15 years in terms of vol premium. I'm talking about the level of the VIX over realized SPX volatility. So that level suggested, that width or that spread suggested that people were quite well hedged into this expiration, right? And what has happened over the last few days is that vol premium contracted. That spread went from about 12 points to about 8 or 9 this morning. And then at 9:30, you saw with the low of the VIX for, I believe, the last week, we tagged around 21, right, in the VIX. As soon as we hit expiration, we saw about $2.5 billion worth of short-dated puts sold in the S&P. Market rallied back up to 6,700 today, right? And then since then, we've just sort of been drifting lower. And it looks like whatever Powell has said has basically just I think, put everyone in the same camp that oil is kind of the determinant of what's going to happen in this future, right? So what we essentially have now is a situation where Fed's not going to help us out at the moment. Nobody wants upside at all. Calls are really cheap. If you look at skewness, so no one believes in that upside right now. Nvidia failed to spark any upside recently, right? You said the dollar's a little bit bid, as you noted, and so what we all have now is we're all basically oil traders, right? If oil continues to go higher, that means inflation obviously is probably going to be going up. Rates aren't going to come and save us, and the equity picture starts to get kind of dim, right? And suddenly you start to look at this major level to the downside into certainly Friday, if not a bigger level into the end of the month, which is 6,500 to 6,475. Those strikes are very important because we have the JP Morgan collar trade. Their put is struck right in that area, right? And so you have to start looking at that as the next major level of support and kind of this opportunity for another leg down into that level into the end of the month. And I think that's the level right now that seems to have the greatest amount of pull to me is that downside strike. And I know I'm a little bit long-winded here, but I'll just add this, Oliver. Markets are about uncertainty, right? And everybody knows what the story is right now. Obviously, I saw some stuff on X about this. We all know the private credit story. We all know that oil's sort of bid right now, right? But we've had indicative support in the market, meaning the Iran situation is certainly, I think, worse than what most people expected from a week or two ago, right? The credit situation doesn't really want to go away. It seems like rates are creeping up, if anything else. And so our people's expectations are tied to the lack of volatility that we've had, right? And so you go, well, yes, oil's a problem, but markets really stayed pretty contained, as you mentioned. And so I think what the risk is here is that we start to realize volatility that we haven't seen yet. S&P one month realized volatility is at 12%. That's really very low, right? Historically, the market moves at about 68 basis points on average. So 12% realized vol saying we've been moving over at 75 basis points a day. That's average, right? Mm-hmm. Even though the VIX is 20 plus, we have not yet paid the piper in terms of vol. And what I think is starting to creep in here now is a real lack of belief kind of in the system in a way, right? Because this Iran situation politically is looking pretty bad, and I don't want to stray into that lane necessarily, but the idea that oil could suddenly start to get really bid from this level, $100 crude, seems quite real, and the knock-on impacts of that at this moment, I think, are really critical because you start to go, the credit market is really not going to like it if rates start to get jacked up, right? And then the midterms, in terms of swinging from Republican to Democrat, is also tied to this, which then starts to take the kind of Trump economy down. So you start to end up with a situation where the known unknown, in terms of oil being unknown, what could happen there, we know that that's an ugly situation, but the chance that that spills into something that we all weren't pricing in, I think starts to get pretty real at this point, right?
Yeah. Brent, the real key point here is that volatility keeps overpricing the actual move. Now, today, obviously, we're softening up a little bit, but the fact that we've just been range-bound now for really months, I described it as the kind of options traders' paradise. I mean, it kind of seems like that's a fair way to think about it, right?
Selling options in this environment has been overall pretty good, I would say, right? I've noted that call prices have come down a lot, so the overriding is not as juicy as it was, even a few days ago. That really seems to have dried up. And so, you think about that and you go, well, Brent, if those calls are so cheap, don't you want to buy them? And I think you can make a case that you want to own some of that, because what happens if Trump suddenly makes an Iran deal and oil drops back to $80? Well, the market's probably going to rip then, right? Because we still have this fat vol premium that's got to come in. But the problem is with that, Oliver, is that if you look at Polymarket, it's 80-something% chance that this situation is not resolved before the end of March, right? And we're one kind of missile away from, I think, people really going, this situation is really pretty bad, and oil really makes another jump higher, right? And you saw like Europe doesn't want to get involved in things like that. So it seems like it's trending worse, right? And I know that's my ignorant assessment of the situation, but why I care about that is because if oil is staying at or higher in terms of price, then vol is going to stay at or higher, and that means that downside has the opportunity to jump. Now, in terms of the volatility premium, yes, 1 month out is what the VIX is measuring. That has a pretty good premium, right? 9 vol points, and we're clearing some of that vol out today with expiration. But short-dated options, if you look at the 0DT straddle today, Oliver, it was only $44. And so that barely covered the overnight move. We were up 50 bips this morning in terms of futures. We've given all that back and then some. On an FOMC and PPI day, we were only having 44 $44 straddle, which is about 70 bips of movement was what's priced in for today. So that short dated option is still not respecting the volatility in certain terms. And so I think what all this comes back into is that the chance of a real jump in vol terms here, that jump risk to me is very, very high because of the Iran situation. That spills into rates, and then you can kind of cascade, daisy chain the risk off situation that we could have. Correlations are quite high, right? Equity correlation is quite high in that either you want to own equities in this environment or you want to own bonds or you want to own commodities, right? It's not, the story right now is not, do I need to go into semi? Do we need to talk about SaaS right now, Oliver? Do we need to talk about, the future of AI and chips? That whole story, which dominated the picture pre-Iran, right? We were all talking about, is this the end of SaaS and everything like that? Well, no one's discussing that anymore. It was like NVIDIA was just a road bump. Nobody cares right now because everyone's so focused on oil. So that equity correlation has really jumped, which to me says at some point everyone goes, look, I don't want to be in equities anymore right now, right? The risk is too high. I need to either go into bonds, dollars, commodities, whatever the other asset class is that's moving or it's just more interesting, more relevant at this moment. And that, to me, again, is this situation where you go, this is where a big vol jump could happen from, right? And that, to me, is the real risk right here. I think owning stock is a pretty sketchy situation at this moment. And the chance for a slippery downside move here is really significantly increased.
What about just doing the old buy right, own stock and sell call against it? Brent, is there a way to take advantage of this without actually trying to bet on that big cataclysmic move?
I think you want to own, if anything, you want to own call spreads right here. And I'm talking about the S&P. And the reason for that is because call skew is really, really cheap. It's like 4th percentile, 5th percentile, which tells me that slightly out of the money calls are really pretty reasonably priced. Puts are fairly expensive, but the problem with that low call skew, Oliver, is you don't want to sell calls when the call skew is at 4th or 5th percentile, right? That tells me they're relatively cheap. And imagine what happens if a deal suddenly is signed with Trump, which any day it could be, right? Who actually knows? And then suddenly oil tanks and the market rips 2, 3, 4%. You don't want to be short calls in that situation, right? You kind of want to, you really want that upside move to start expressing itself and that call skew to go bid before you start to sell calls into that. So, it's a tricky situation there in which you don't want to cap your gains in that type of environment. Like, you want the protection, obviously, but you don't want to cap your gains because you always have that right tail risk in this type of a situation. And so I like put flies in this environment or put spreads in this environment right now against long stock if you want to do that. I think stock replacement, forget owning 100 shares of spiders, just go buy a spider call or a call spread. I think would be make a lot more sense based on the vols that we're seeing or the volatility surface. Certainly in the S&P, obviously different stocks have different idiosyncratic risks here. But from a macro perspective, that's what I'm really seeing. And then the second trade that I think is interesting is the oil trade, because while there's a lot of nuance with forwards and things like that in the oil market, I think you could do put flies in USO, let's say. So you buy one near the money put and sell two farther out of the money put, going maybe a month out. The reason I like that is because if there's any type of deal trade was put on, right, and oil really drops, that's another way of getting kind of synthetic equity upside in a way, I think. And if oil drops, that oil vol is going to come in, and I think short dated kind of a month or under put flies in USO or similar oil names could be profitable in this situation if Trump is able to pull off some kind of a deal.
Okay, so the idea of 125 plus crude oil, fading that to some extent?
I think, I'm not going to sit here and say I know, right? I just think that the ball is very high and you can get really good risk reward in that situation. The opportunity for oil just to go 150 or 200 totally could be, right? And I have absolutely no idea in that case. What I do know is that oil starts to make that move, then equities are going to get slammed, right? And vol's probably going to pop. And so, again, back to the original point, we're all equity traders are just basically oil derivative traders, right? Because that's all at the moment equities are. They're just a derivative of the oil trade. And
it does seem pretty closely tied.
Yeah, and that vol, look, if crude goes 150 to 200, VIX is going 30 to 50, right? And I think that's the tough situation. And trying to figure out which way is up in that market is nearly impossible at this moment. So again, if you want to play that upside, you can get call spreads in the S&P for really cheap right now. And I think that's a reasonable way to go. As opposed to saying, I want to buy stocks here. We're really only 2% off of all-time highs, maybe 3% in the S&P. So ultimately, when you zoom out, it's really not that been much of a risk-off situation, even though VIX is over 20 or 25 like it is, even though put skew is really high. So to me, the thing that just scares me is that downside jump in vol where we finally pay the piper and have that kind of 5% risk-off equity day because people just give up on stocks and say, okay, I got to go into, safety, whatever that safety may be at this point. It's not totally clear to me what safety is, Oliver. Do you want to own bonds in a risk-off situation if that means rates are going to jump? I mean, it's a weird, tough call, right? What is that right tail equity hedge, which historically says, oh, I need to go long bonds in this situation, right? 60-40 portfolio, et cetera. But in this case, do you want to own bonds like in 2022? Do you want to own bonds for risk off in equities? I don't think so.
Yeah, that's where, we're seeing a lot of the alternatives, come in, which is options-based stuff. Obviously, the buffer fund's popular yesterday. BIZD was picked from Peter Cheer, looking at some of the private debt stuff, because bonds are getting smoked, obviously, and that doesn't help. But that is kind of the beauty of going through these options approaches, because there's income in those. I mean, that's kind of the idea, right? Is I guess it kind of makes sense to some degree. The market kind of creating that new opportunity using options if bonds are going to be, losing their role as kind of that ballast to a certain extent.
That's right. And the other thing is you'll see a lot of people, particularly on X, right? And they say, okay, the VIX is elevated, so we're going to sell, or bet on UVX if that VX is coming in, because to me, the problem with that here and now is that nobody knows what's going to happen with this Iran situation. So you don't want to be short options, particularly to the downside, in a situation where risk could easily flare, significantly. We're talking about a once in every 5-year type volatility move. That's where we're on the cusp of, right? And I don't want to be the boy who cried wolf with the panic, but when you have the VIX simmering like this at 25 and put skew is bid, we just have not had that realized move that makes vol really jump, right? And I think that is the risk here again, is that if we do spill off 2, 3, 4% in the S&P, then suddenly I think you're going to see vol really spike, implied vol and the VIX really spike on that type of a situation, or on that type of a realized move. And we've not had that realized move, which has actually kept, I think, the vol market relatively contained. And so you just really want to be careful that vol positioning when the Middle East could get worse at any moment. And I hope it doesn't. And I have no idea. It's just, look, that's a known unknown. We all know that could get a lot worse, and it could get a lot worse very fast. Now, the moment a deal is signed, or it seems like there's light at the end of that tunnel, then I think vol is going to get slammed and the market's going to rally really quite sharply. But until that, you can see the whites of that deal's eyes, so to speak. I just think you got to be really, really quite careful in that situation. And at the end of the day, it's like, look, there's no need to be a hero here, right? And Oliver, we're about the same age, and I think the last time, if you remember, that oil went really crazy, right? 150-ish, sniffing 200 was in 2008, I believe it was, right around when Bear Stearns went down, right? And that was this weird oil move where it seemed like, the age of oil or cheap oil is coming to an end. And that kind of was an initial move into this whole great financial crisis. And I'm not smart enough to remember that all that stuff was linked, but in a similar situation here, if you had that pressure, that inflationary pressure, and then the rate market goes weird, and then people just lose complete confidence in Trump and everything else, it's like, you could, again, see this daisy chain of risk unfold just really quickly, and I think really violently, and I think that's a real risk you want to respect.
It's interesting because it seems like I would totally respect that, right? But so much of it does kind of hinge on this geopolitical element. It's funny, I was getting lunch with a trader down here today, and he was talking about how, the kind of fading of volatility in the Trump regime, we've kind of gotten used to the kind of range of outcomes that are unpredictable under Trump. But obviously with VIX steadily creeping, everybody's got their breaking point, right? Everybody's got their breaking point.
That's right.
At least for now, harvesting the premium generally has been the move. But to your point, don't be a hero in either direction. Don't bet that we can't have a big move to take us back to VIX 30 plus. Give you last thought, Brent.
Yeah, I would totally agree with that. So I would just stay away largely from short vol positions. I think that for the very short term, looking at big market supported about 6,500, is real here, just until March, right? And then after March, I just don't. Last point, Oliver, is that if you remember, and this is another situation that's going to make me sound like a whack job or whatever, right? But if you remember back to COVID, right, and everyone was freaking out about COVID in February and saying, why doesn't the market react to this, right? Why doesn't the market react to this? And then we hit options expiration, and then suddenly the market just cascaded into March 2020, right? And in this situation, it's like, is this the kind of put clearing event where maybe realized vol can move a little bit more as we move through an expiration? That's fair. I don't necessarily say I'm calling for that, but I'm saying if it happens, you don't want to be surprised about it, right? And I think that's another point.
Fair enough.
Watch that short vol, and if we get that realized vol actually starts moving, then I think you're going to see VIX well over 30, and things could get pretty ugly. So that's a big risk here.
All right. Like it. Brent, thanks very much. Know you're on the road. Appreciate you jumping on.
Thanks, Oliver. Take care.
You got it. Brent Kochuba at SpotGamma. I got Mr. Jon Najarian on the line. We got Sky Nations right behind him. We got a busy afternoon here. And there he is. What's up, John? And we do got a decent little internet connection flowing here. It's kind of spotty. I guess VIX popped. They're sucking up all my internet down there, John.
Well, I'm sucking up all your internet from out here in Las Vegas, where I'm out here for a couple conferences, and then I go out to New York for a talk about AI. But man,
nice.
It's been a fun time to be trading in these markets, folks. That's for sure.
Really has. What are you trading in down there in Vegas, John? You at the craps table? You blackjack?
I don't gamble, man.
Oh,
You're the gambler.
Well, shoot,
I
gotta change. I gotta change the whole. There's we'll just do a little tease. Bing, there it is, and then we're back.
The gambling I do is on sports.
Yeah, there you go. Exactly.
Yep. The rest of it is all just trading, and I think as long as you're still nimble here in these markets right now, that's not saying every trade I make is a winner. I'm not implying that, but I think when you see, like this weekend, when we had crude oil up over 105 and then it broke to 90, I think that was a huge opportunity because nobody was focused in on that petro line that runs across Saudi Arabia from east to west. 1,200 kilometers of pipeline that, allow the ships to pick up the oil on the other side instead of going through the Straits of America. Used to be formerly rather Straits of Hormuz.
Yeah, we're renaming everything. We're just watching a live game of Risk being played, basically.
Well, you know what they always say, to the winners, they get to write history. And
yeah, that's fair enough. What do you think about Brent's possibility, John, for like a VIX spike from here? Do you want to, if you think that America's going to come out on top, should you be selling the heck out of volatility right now?
No, but I do agree with Brent. What I really think, Oliver, is that you sell it when it gets to 30 or 35. Okay. You don't sell it at 22 or 21 where it was, Monday and Tuesday, okay. 21, 22, given what's going on in the world. So okay, I would be a seller, but I would be a seller of vol, just like I was a seller of OVX. That's the volatility of oil. It was up around 125 and it crashed. But now would I sell it after the crash, even though it could go back into the 50s? No, I want to see a pop. And so to Brett's point, and I think where he's exactly right is, under the right set of circumstances, you could see a spike in vol, but it'll, I believe, and I think he thought so too, very short-lived. The spike to 35 last week lasted a little more than 4.5 seconds.
Yeah.
These aren't like, you get a long time to sell it up here. No, you'd have to be, in there selling it right away if you wanted to take advantage of that. So am I all that hot on selling it at 23 and 24? No, I'm not. I'm waiting for a real pop, not just a little bit of a lift, and then I would sell it with both hands.
Okay. Today we are moving towards the volatility pricing because earlier it was VIX 24 and S&P down 3/4. Now it's, VIX 24, S&P down about 1.25. So we are kind of closing that gap in the favor of the volatility, to both your guys' points. But I just look at the backdrop, and I know that Powell's on hold today, but the general stability of the economy seems like it's still there. But there's obviously complications here, John, because if you were looking for the Fed to cut, that might be getting pushed out with all this uncertainty.
Yep, and I agree with that 100%. The assessment is that during times of uncertainty like this, the Fed would be loath to make a cut or make an increase if things were superheating because of that uncertainty, the known unknown, as Brent said. But I think that the opportunities before us are going to be massive. I mean, it's not just Jensen Huang talking at GTC about $1 trillion in Blackwell sales. It is what that is going to do to transform a lot of industries and make them more profitable. Now, the contra to that, of course, is that it'll put a lot of people out of business. We've already seen Amazon and a host of others, Meta, talking about the decrease in their work force. Unfortunately, I don't know of a solution that is going to help that. I know that a lot of people will be working other jobs rather than as coders and so forth.
Yep.
And I am sympathetic.
There's disruption
to that.
there. Yeah.
Yep, I'm sympathetic to it. But what can I do? Can I say that, well, we got to stop that? We got to stop companies from being profitable?
By the way, cloud stocks are up 1%. That group has actually been hanging on okay after getting obliterated. So I wonder if that has started to get priced through to some degree here. And also, by the way, the chips, which to your point about NVIDIA GTC, they're only down 0.5% today. So there's a lot of stuff that generally is hanging in. What are you trading, Johnny? Stocks that you're going for, that you like, that you're tracking? I mean, last we talked, it was memory.
I still like over the things in the oil patch. So one of them is Sable Offshore, because if the president has enacted War Powers Act to get California pumping again offshore, off of Long Beach, off of Santa Barbara and so forth, that's Sable Offshore, SOC. So I was buying that. That's stocks that help get things out of the ground or under the sea. Sable doesn't have to be a deep water driller to make things happen with the rigs off the coast of California. A lot of those are not in deep water, as it's defined by the oil industry. Are they down there hundreds of feet? In many cases, we're looking at companies like NVIDIA that are a $4 trillion market cap. That's swinging things a lot more than the energy stocks are, because it takes 20 energy stocks to equal one NVIDIA.
Yeah, no, that's a great point. I mean, the market cap is obviously concentrated in the big tech and NVIDIA, the MAGs in particular, which have been holding on pretty well. Thoughts on the gold silver trade, John, that's buckling a little bit here?
I would still go for the miners instead at this point. I would
still
like
a
go
GDX?
for GDX and GDXJ, the junior miners and the regular miners, because they are moving much more like silver. They are outperforming gold by a long stretch. So if you're somebody who still believes in that trade, which I do, I would say on dips like the kind we've got.
Big dip today.
I would be a GDXJ or GDX buyer, rather than the physical, rather than the GLD, which of course the ETF for the physical.
Okay, love that. GDXJ getting cooked, but an opportunity there perhaps is, the trend has been to buy those dips. Thanks, John. Like it. Enjoy Vegas. Don't do anything I wouldn't do. Sounds like you're behaving out there.
That doesn't limit things much, but I'll be good. Thank you, Oliver.
Thanks, John. Appreciate it very much. Jon Najarian, Market Rebellion. All right, when we come back, we're going to look at the pricing and out of the money options with Mr. Scott Nations. Be right back.
increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovator's floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
All right, welcome back to the show here. We're up in the bird's nest at Cboe today as the stock market is under pressure. S&P 500 now down 79 points. VIX sitting pretty cozy, up at 24.5. But VIX, as helpful as it is, arguably doesn't tell the entire story. Let's broaden out the tale. Mr. Scott Nations joining me today, the president at Nations Indexes. What's up, Scott? How you doing, sir?
I'm good. Yes, what's up? It's certainly not the stock market. Some volatility measures are up today, but
volatility up a little bit. Tell me how you're looking at that. Love that jacket, by the way, back there.
That's old school, man. That is old school.
I like that. Yeah. You were sporting the red.
Oh yeah. I was fancy bright red polyester jacket.
So you could stand out, not as if you didn't stand out already.
There you go.
Okay, so tell me, Scott, what you're looking at. You guys have an interesting way of looking at volatility. You and I talked about it a little bit last week. Tell me about the way you measure volatility through your put decks, call decks, and the way you think about pricing of out-of-the-money options, right? Kind of like far out of the money.
Yeah, Oliver, we think that you have to deconstruct skew to understand what's really going on. Listen, VIX is the volatility index, but if all you do is look at VIX, and it's tough to know what's going on in different swaths or different sectors of the skew, and what's happening today is really instructive. So Voldex, which is purely at-the-money implied volatility, ticker VOLI, V-O-L-I, is up just more than 10% today, about as you would expect with the S&P down more than 1%. So at the money volley up 10%, but deep out of the money puts, I mean really deep out of the money puts as measured by Taildex, that ticker is TDEX, is essentially unchanged. And what's that tell us? It means that traders are buying at the money options. They're not worried about a real big sell-off. They're not worried about a tail event, so they're not buying those. But they're buying precisely at the money options in the S&P because they think we're going to have plenty of volatility and they want to participate straight away, right away. They don't want to only participate if the stock market drops a ton. That's really instructive because it tells you that while they expect a lot of volatility, they think it's going to be reasonably contained within a range of, say, up or down 2 or 3%.
Okay. That figure, Taildex spiked big earlier in the month on the 9th.
Yes.
So, I mean, you did have some pretty big moves and it came back down. Tell me kind of what's rare and what levels are sustainable sort of from this perspective, Scott?
Yeah, Voldex, volley over 20 today. That's pretty high for at-the-money implied volatility. But for both Voldex and Taildex, the important levels are between 45 and 50, way above where we're at now. But those are the highs for each of those in April, last April, when we had a bunch of tariff turmoil. One other thing, Oliver, to point out, and we were talking about this started talking about this 2 weeks ago, is risk dex is the ratio of the price of out-of-the-money puts to out-of-the-money calls. it got very high 2 weeks ago, extremely high, unprecedented levels. And that really signaled that the market was vulnerable to this sort of news, and it was much more likely to take a leg down than it was a leg up. Now, the S&P's not down very much from its all-time high, but it has come down from its all-time high. And so that's an important metric to watch. It's a measure of where people are really positioning, where they're buying options, as opposed to the old-fashioned put-call line, which is volume. And we know that, call volume, a bunch of call volume, not necessarily bullish if people are selling covered calls, and the same is true with puts.
So the risk dex out of the money, it's basically an out of the money skew, right?
Yeah.
So you're kind of looking at the tails, if you will, and people were speculating on big drop or just selling the idea of a big rally.
They were buying out of the money puts, the one standard deviation out of the money puts. For Delta, that's a 16 Delta. They were buying those because they were worried, but also they were happy to sell the one standard deviation out of the money calls because they didn't expect stocks to pop. And both of those things happened.
That's pretty interesting, yeah. By the way, I was doing some back of the hand math today on the VIX rule of 16. You just gave a nice little back of the hand math on standard deviation 16 delta there. So low delta, very far out of the money, but quick to change. Price can change fast on that bad boy if you own it.
Yeah.
Right?
Yeah,
so,
and again, we like to pay attention to price rather than volume because that's what really matters. Price is truth, and so pay attention to price.
Yeah. Okay, so then what will you be watching here, Scott, to know if the market is going to stabilize or, I mean, the main thing we're trying to glean here is we already have an elevated volatility environment. Does it get even more extreme? Do we get into that kind of standard deviation plus style event, or are we more likely to balance out? What will you be watching in your metrics?
Yeah, Oliver, the thing that I really like to pay attention to is call dex. And again, that is the price of the one standard deviation out of the money call. And what happens if we have a sell-off like we're having now, a reasonable sell-off, you will often see traders selling those out of the money calls because they want short exposure to the market. Now, what happens if the market continues to drop? What if the market were down, say, 3 or 4% in the course of a day? Then when you see call dex increase, completely out of character, that is completely counterintuitive, what does that tell you? That tells you that traders are now really afraid and they're buying implied volatility in the cheapest places they can buy it. So if the market is down a bunch and call dex is higher, that's really worrisome because it means that traders aren't really buying calls to get upside. They're buying calls delta neutral to get long volatility.
Interesting. So you're using them as hedges.
Yeah. They want to be long the volatility, and they're just reaching to buy the cheapest options available, which are often those out of the money calls.
Okay, that's very interesting. And so are they doing that right now? What is it looking like, Scott?
Yeah, not yet. Okay. Right now, call dex is actually...
We're looking at it. It's at 11 roughly, 10 and a half?
Yeah, and that's still relatively low in the scheme of things. And so they're not yet reaching for those. And I wouldn't expect them to. With the S&P down today, but not down more than 1.5% right now. And so that's really the thing to pay attention to, though, for the first indication of real fear. When the stock market is down a substantial amount, say 2%, and people are starting to buy calls, then you know they're afraid. They want to be long volatility. They want to buy those delta neutral. That's really interesting. If the stock market's down like it is now, and call dex is essentially unchanged, maybe a little bit lower, that means that traders aren't worried about volatility and they're selling those calls to get short exposure to the market. Got it.
Okay. So they want to get the short exposure to the market. All right. Well, obviously it's hard to find predictive things from this, but there's some nuggets in there, right? I mean, there's some nuggets that tell us that I think that people are still comfortable thinking about volatility remaining elevated.
Yeah, and again, the picture that risk dex painted 2 weeks ago It was like people had heard from God, like they'd heard the voice of God. It was really pointing to the fact that the market was going to have a tough time rallying. It'd be easy for it to break. And much of this happened, some of this happened after the war started. So a little bit happened before the war started. So RiskDex is a really, really interesting way to look at momentum, but also conviction. Because when people are really willing to bid up put prices is when they're afraid. And if people are willing to sell covered calls, well, we know what that means. It means that they expect the market to be sideways or down and not to be up over the next 30 days.
Like that. Nice. Great perspective, Scott. Good nuggets in there for volatility and looking outside into the extremes. But I mean, yeah, you got the at the money stuff too, though. So I mean, it's definitely a nice perspective for us. Appreciate it very much, Scott. You the man. Thank you.
Thanks, Oliver.
Mr. Nations, present at Nations Indexes. From one Scott to the next, we got Bauer taking us into the bell here for some trades right after short break. 15 minutes left into the session. S&P 500 right now down 89 points, so it certainly is kind of falling apart here. We're at the lows from a couple days ago. We'll be right back.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
All right, we got stocks getting hit pretty hard today. The S&P 500 down 89 points right now, closing in on the lows that we just put in. So we are definitely under some pretty serious pressure. We got Mr. Scott Bauer joining me on the line for Prosper Trading Academy out in Great Colorado. Scotty, this market is kind of falling apart to some degree. What do you think?
Yeah, this morning, Oliver, I was really surprised that we didn't see a push higher in rates after PPI came out. It was actually too calm. It was really too calm. And what we saw happen with silver and gold, with the big drops that we saw today and that we're still seeing, there's a huge disconnect there. So silver and gold were acting like rates are absolutely going to move higher, but then rates weren't moving higher until this afternoon, and really over the last hour or so. Now we're seeing the 10-year on its high of the day in terms, of 425.5 or so. So that really stood out to me today. Also, what's standing out is the VIX is inverted now. It is in backwardation right now, but it's not really so severe. Normally when we see kind of a big shock to the system, or people really, nervous about a big impending sell-off, we'll see a big backwardation, meaning that the near term, the front VIX is much, much higher than going out a month or 2 months. And though it is higher, and that is, we're typically not in that state of backwardation, it's really not that much higher. So yes, we're seeing pressure. Yes, the put skew all over the place, which was really expanded a few weeks ago, has widened out again today. But I think this 661, 66 in the S&Ps is going to be pretty critical.
It really is. It seems like market is not content until testing it again. Given that we had some strength, some stabilization, we even had highs in some of the chip names like Micron and others, but no ability to rally the larger group of troops. Every sector today is down. Discretionary down the most, staples right behind it, both those groups selling off. Interesting. And the line in the sand pretty clearly here at 66. I mean, we've literally had a line there for months.
Yep, it really is, and we'll see what happens. I wouldn't bet against it just dropping slightly below and then seeing a recovery, but anybody can make predictions. I'll be right 50% of the time, wrong 50% of the time, depending on what happens with this escalation in Iran, right? Yeah. That is driving so much of what we are seeing. And that's also driving what we have yet to see with inflation, because those PPI numbers today didn't even include this, the start of the war. So that is definitely going to be a concern. Now, you said consumer discretionary was getting really hammered today, which it is. There's one stock though I really like, and you talk about coming down to critical support for the S&Ps. Walmart is there also. Walmart is right at critical support.
$122.
Yeah, we got long it today. Just by buying some call spreads, not outright on the stock. And this has been a line in the sand for Walmart, and we've seen it bounce nicely several times. In fact, we've been in and out several times recently. We're back in again. So We'll see what happens here in Walmart. Full disclosure also, Oliver, I think I was telling you offline, GLD. We're a little bit in the middle of nowhere now. I think this move down, as much as I said, that this move was really because I thought rates were going to move higher, I think it's overdone. I really do. So we did get long GLD also, again, using some upside option strategies.
Kind of looks like 440 a spot in GLD. That might be some support. Okay, so spreads on the long side for your conviction plays in gold and Walmart. For the market in general, Scott, I know you had talked about iron condors as a way, selling spreads out of the money to try and get some income, some premium betting on that range. Does that trade continue to work if we break down past 66?
Yes, it does, because I'm looking at individual stocks rather than selling an iron condor in the Qs or IWM or the S&Ps, whatever it is. So yes, now at some point, it's not going to work. It has been paying off very, very handsomely over the last couple weeks, especially if you have played these iron condors with a little bit of a directional bias to them. A couple of them that really stood out, and I think we talked about these last week, ADI and Goldman Sachs. Both of those stocks came down to massive, massive support last week. Volatility was really, really extended. We sold very bullish iron condors on those, paying off big time. I do have another one on right now, which is actually a bearish iron condor. That's in Western Digital. And that thing, it's kind of a proxy to Micron. So that thing could move big after the close today. This one is a bearish one because that is up near some big resistance. We'll see what happens here. I have a feeling that after Micron earnings, that volatility that we're seeing pretty much across the space is going to come down considerably.
Take me through the structure of that trade then, Scott. When you talk about more of a bearish iron condor, does that mean you're going to be selling the call spread pretty close to the money where it's at right now?
You got it. In fact, the exact position we have on is short the 312.5, 317.5 call spread. And this is all for next week. And we're short down below the 265, 260 put spread. So just like you said, that call spread, pretty close to being right at the money. In fact, it was actually in the money a little bit earlier, and it was yesterday. So that is the complete opposite, but the same kind of strategy as what we did with Goldman and ADI, but on the opposite side.
Got it. Okay. I like that approach. Looking at the range trade still, but then kind of capping it right where it might be finding some resistance. Micron had a nice big move. They all did. SanDisk. Micron suggests maybe it could keep pushing here a little bit, but
it might.
How far can those disconnect if the market does break down further? I mean, so far they've been disconnecting pretty well, but there's got to be a limit somewhere.
Look at SanDisk too. SanDisk has become GME and AMC.
Yeah. No, really, SanDisk is just amazing. Another update there. The cloud stuff too, holding in higher. IGV down. You do have Microsoft down, but CLOU, which is a little bit of a different composition, but still a chart that looks decent. The Bitcoin bounce definitely got smacked today pretty hard, Scott.
Boy, yeah, if I could only tell you how many people said yesterday, people that I spoke with everywhere, this is the breakout for Bitcoin. And it still might be, right? Maybe this is just a risk off today. But yesterday, everybody was uber bullish on Bitcoin and crypto. So, again, I mean, in this market, Oliver, regardless of an opinion, regardless long, short, whatever it might be, you just got to keep things really close to the vest.
Charlie's Circle still, though, pretty good, up 0.25%. I don't know how that thing is just
Charlie's Circle is a monster.
In a world of its own. Yeah.
Yes.
Okay, so looking for, I think, the rest of this week, Scott, the macro situation, maybe is important, but I think after what we saw with PPI and the response to it, bonds selling off definitely complicates. I don't know if that's the full story necessarily. What do you think kind of drives this bust? Because we do have a big options expiration coming up.
Huge options expiration, which the last few triple witch, quad witch, quarterly expirations like we have Friday, they've kind of been a dud a little bit. We would expect some more volatility and especially more volume. But right now, driving the bus obviously is geopolitical events. What's going on with oil? Is there going to be a further escalation or not? The eco data that comes out right now, I'm not going to say it's irrelevant, but it is absolutely secondary to what happens overseas.
Yeah, agree. PPI not looking like a good indication of potential crude ramifications, and WTI finding consolidation and support in the mid-90s is lasting way longer than I think anybody wanted it to.
Let's call it 90 to 105 range. I don't know how long we're going to be in that range. That seems to be it for right now. The longer we coil in that range there, I think that sets up the opportunity for a massive move one way or the other. The longer we stay in that range, that gets extended. I honestly think when this whole thing calms down, which again, hopefully is sooner rather than later, we're going to see a 7 handle really quickly on oil. But we don't know when that's going to happen. And if things get worse, if things, really, really spiral out of control, we hear all the calls out there, right? I don't need to be a pundit on that, but we hear all the calls out there, which I think is somewhat far-fetched. Let's say for $200-$300 oil, can we get to 120, 150? Sure.
Yeah.
$200-$300, I think would be pretty difficult.
Well, with the S&P pushing to lows below Friday, or below, the last kind of week as a whole, we're now back to where we were in November. We definitely have crossed below that point of 6,600 a few times, but I think with volatility still elevated, maybe a lesson here to kind of skew some of those premium focused trades with maybe a slightly maybe bearish bias. So maybe you just shift your S&P condor down and sell the call spread somewhere around where we're at maybe.
You know what? If we do break below, then all of a sudden 66 becomes resistance. That would definitely be the play.
Yeah. All right. Well, we'll see if we hold up. We'll see you. We'll see your crew tomorrow. We got Charlie on tomorrow, I believe. Scott, thanks very much. Appreciate it, man.
Have a good one, bud.
Good stuff on the trades. Scan the QR code. Mr. Scotty Bauer, Prosper Trading Academy. Nice lessons learned there on how to approach the market as it is finding some trouble here with less than a minute left. S&P down 92 points. Well, at the beginning of the day, when I walked in here, it looked like VIX was calling for a 1.5% move. We didn't quite get it. There's the bell. Thanks for tuning in. See you tomorrow.